New investor comes in to see a highly prestigious, highly regarded investment advisor. They start chatting, and the investor finally asks his first main question. So, how do you charge for your services? The advisor says, I charge $500 for 3 questions. The investor's taken aback. Isn't that a bit steep? Yes, it is, says the advisor. Now, what's your third question? You know, good advice and valuable insights certainly don't come cheap. And today we are fortunate to reap the insights of some of the best minds in the investment world. And I thank each of you for joining us. For those of you that don't know me, my name is Mo Litsky. I'm one of the principals at Prime Quadrant. And we are honored to sponsor this event as it allows us to support the invaluable work of Mount Sinai Hospital, and especially to bring together our illustrious investment community to share ideas and hopefully become more knowledgeable investors. You know, I often speak about how difficult it is to find best-in-class talent. I mean, anyone that's ever hired senior management could probably relate to this. But believe it or not, in investment management, it's actually more difficult because the odds are stacked against you. You know, our group is an investment research and consulting firm. We spend thousands of hours. One of the things that we do is spending thousands of hours each year finding diamonds in the rough in every asset class. And it's not easy. It's not easy because luck plays a very confounding factor. You know, there's fascinating studies that show that the worst baseball team, the worst team in Major League Baseball, will actually defeat the best team in Major League Baseball some 15% of the time. However, over the course of a 162-game season, the cream seems to rise to the top, and the skillful ultimately emerge. And the same is true for investing. Anyone could get lucky some of the time, even for a period of time. But today we are fortunate to host individuals who are some of the most skillful in the business and who have a proven track record of success over many seasons, many 162-game seasons, if you will. And whether they are older or younger, or whether they manage 30 million or 30 billion, today's presenters are all extraordinary in their own right. So I think you're in for a special treat. And for any of you that haven't done it, I invite you to fill up your cup of coffee because you're going to have to put your brain to use. And before we introduce our first speakers, our first 2 presenters, I just want to take a moment to thank the generous groups that have partnered with us to make this event possible. And if you'll allow me, I really want to mention them individually. So first and foremost, to our dear friend Rob Wessel, a foremost expert on global financials and managing partner of Hamilton Capital. To our dear friends at Scotia Global Banking and Markets, thank you Les Martin, Jensen Schrubb, Daniel Dornbush, and Junan Reed. You'd be hard-pressed to find a nicer group of people. To Jonathan Shields and Plaza Futures Group and RBC Dominion Securities. I mean, anyone that wants to talk about options, futures, hedging strategies, Jonathan is one of the best in the business, and I encourage you to get to know him. Thank you to Kevin Cohn and his team at AUM Law. This is a very special boutique firm that is specifically tailored to serve the needs of investment managers and investors. A special thanks to Entrust Capital, who were incredibly helpful in arranging today's activist panel, and they are represented by Greg Heimowitz and Mark Gariglia. And we are deeply grateful to the young and talented group at Front 4, represented by their Toronto director, David Isaacman. Thank you to David Fry and Andrew Torres at Lawrence Park. Really special group, and if you don't already know them, you probably should. And we'll be hearing from Andrew a little later today. Thank you to Jeff Jacobowitz and David Sandell from Simcoe Capital, the only US manager I know with an Ontario cottage country name. And you'll have the pleasure of hearing from Jeff this afternoon as well. Thank you to our friends, again, this year and last year, to Peter Buffo and Steve Bankier at TD Prime Brokerage Group. This is a great group of guys that are constantly looking to add value to investors and managers alike, and their thoughtfulness is greatly appreciated. Thank you to Katrina Rempel, who is one of my favorite people in the world and the head of BMO's Capital Introduction Group. And last but not least, thank you to Han Investment Stewards, Canada's first and leading firm in employing actively managed ETF strategies, and they're represented today by Robin Graham. I would be remiss if I didn't express a debt of gratitude to Rob Klein of Convoy Capital, whose efforts and encouragement and support and advice really helped make today possible. And thank you as well to my entire team. None of this would have happened without them. To our founding principal, to Ian Rosmarin, to Seth Wassing, Yael Klein, Jeremy Rosmarin, Ann Atchison, and our back office personnel. Now, most of our team is here today, so should you have any questions or need any help throughout the day, please don't hesitate to pester them. Believe it or not, they actually enjoy it. So, and by the way, a special thank you to each of you. Your support of Mount Sinai is appreciated. To start this morning's program, allow me to welcome and please call up to the stage two of the most legendary Davids in the realm of financial services, David Darst and David Rosenberg. If I could please invite you both to the stage to share their economic update. So let me start by introducing our first speaker this morning, David Darst. All right, get ready for this. David is the Managing Director and Chief Investment Strategist of Morgan Stanley Wealth Management and with responsibility for asset allocation and investment strategy, and was the founding president of Morgan Stanley's investment group. He joined Morgan Stanley in 1996 from Goldman Sachs, where he held senior management posts within the equities division, and for 6 years as a resident manager of their private bank in Zurich. David is the author of 7 books: The Complete Bond Book, The Handbook for Bond and Money Markets, The Art of Asset Allocation, Mastering the Art of Asset Allocation, Benjamin Graham on Investing, then The Little Book That Saves Your Assets, which was ranked as a bestseller by the New York Times and Business Week. His financial works have been translated into Chinese, Japanese, Russian, German, Korean, Italian, Indonesian, Norwegian, and Vietnamese. And in 2012, Seapoint Books published David's 7th book, Voyager 3, which contains his creative writing. David appears as a frequent guest on CNBC, Bloomberg, Fox, PBS, and other television channels, and has contributed numerous articles to Barron's, Euromoney, The Money Manager, Forbes.com, the Yale Economic Review, and other publications. He broadcasts and writes extensively on asset allocation in the firm's biweekly investment strategy and asset allocation commentary, and in the Morgan Stanley Wealth Monthly publication, Asset Allocation and Investment Strategy Digest, the predecessors of which he launched in 1997. David holds degrees at Yale and Harvard, where he also served as a visiting faculty member. It gives me incredible pleasure to invite David Darst to the stage. Thank you.
Mo, thank you for your warm and gracious words of welcome. Ask all of you to give a thought. I know this is in honor of Mount Sinai, but please give a thought to the folks who are suffering from Super Typhoon Haiyan. As many of you who speak Chinese in this room know, the word Haiyan means petrel, which is a seabird. The petrel bird was named because of St. Peter. St. Peter's, in the legend of the Roman Catholic liturgy, he would hover above the waves, the water. And the petrel bird is named after St. Peter. And this bird, Haiyan, is the Chinese word for the petrel bird. The President of the Philippines just declared a state of calamity, which exceeds that, in his words, of the devastation and destruction, loss of life, loss of property, exceeds that of the 2004 tsunami. So I hope you all, in addition to Mount Sinai, will consider the American Red Cross, the Philippines Red Cross, Habitat for Humanity, Save the Children, and UNICEF. Those are among the relief agencies and organizations. And I would be also remiss if I let pass Remembrance Day yesterday in honor of those who have served this country and the cause of freedom in the world, dedicating their lives, their courage, their intrepidity, bravery to do so. Now, we're going to talk for about 15 minutes, 10, 15 minutes, and then David's going to speak. Let me just quickly break it down, the big stories of the last 400 years, the big stories of this century, and the big stories of this year. The big stories of the last 400 years are, first of all, the 1700s, ladies and gentlemen, were a century of the loss, the abolition of omnipotent kings and queens. That's symbolized by King Louis XVI in 1793 at age 39 being beheaded during the French Revolution. The 1800s, as you know, were about the abolition of slavery and serfdom. It started, believe it or not, in Haiti in 1801, 1802 with the revolution there, the first revolution in this hemisphere, building on the French Revolution. It is symbolized by Abraham Lincoln signing the Emancipation Proclamation, July 1st, 1863. 150 years ago, we celebrated that in the United States, abolishing slavery. Notice, he signed it July 1st, kept it in his desk drawer for 6 months to wait for one victory by the Union Army before releasing it. It was only released in January 1st, 1864. The 1900s were about the abolition of fascism, totalitarianism, and communism, emblemized by Joseph Stalin dying in 1955, Mao Zedong passing in August of 76, and you-know-who killing himself in a bunker in May of 1945. I'm not going to say his name. And now this century, ladies and gentlemen, is symbolized, and when your children and grandchildren sit down to write the story of this century, 1700s, abolitions of omnipotent monarchs, 1800s, abolition of slavery, 1900s, abolition of fascism, totalitarianism, and communism. This century, 100 years from now, will be about the abolition of the oppression of women in Asia, Africa, and the Middle East. And that is symbolized by two people, Caroline Criado Perez. Does anybody know her name? Caroline Criado Perez. Caroline Criado Perez keeps a blog, has been done so. She's a feminist, been doing so in the United Kingdom. And shortly after Mark Carney was named head of the Bank of England, one of his first official acts, as you know, she's been advocating to put females on the front of the British currency. On the back, you have Queen Elizabeth II. She says, we have Isaac Newton. We have Michael Faraday. We have William Shakespeare. We have no females. So Caroline Criado Perez convinced Mark Carney as one of his first official acts at the Bank of England, which was founded in 1693. The Fed was founded in 1913. 1693 is 320 years. His first, in his top 5 first acts, was to put Jane Austen on the 10-pound note. Jane Austen, as many of you know, lived from 1775 to 1817. 42 years. Pride and Prejudice, Sense and Sensibility, Northanger Abbey, Persuasion, and 2 more novels. And as a result of this campaign, Caroline Criado Perez has been subjected to, she just had an article in the Financial Times 3 days ago, she's been subjected to over 400 rape and death threats. Isn't that crazy? This woman just basically asking, and she connects to the real symbol of this century. This century will be about the abolition abolition of the oppression of females in these other territories, half the world. And her name is Malala Yousafzai. Any of you who have children, daughters, sons, nieces, nephews, grandchildren, you should go on YouTube and put in Pakistani girl addresses the United Nations. Because on the July 12th of this year, her 16th birthday, she, as you know, keeps a blog. She says, I was raised the same as my male sibling by my father to be educated young woman. This guy gets on the bus in northern Pakistan with a gun and says, who of you is Malala Yousafzai? She said, that would be I. And he came over and shot me through the face, neck, and shoulder. She was airlifted to Birmingham, England, where she is recovering, lives with her family now. And she gave an address July 12th, her 16th birthday, which ranks up there with Martin Luther King's 1963 in front of the Washington Monument. It's phenomenal. You must watch it and spread the word and get your kids to watch it. Because she advocates for kids, young men, young women, human rights. She spoke on Friday, July 12th, her 16th birthday, at the United Nations. It's a phenomenal speech. So those are the stories of the last 400 years. The stories of this century are four. The rise of China, symbolized by Deng Xiaoping, the greatest structural reformer. This Paul Martin, Pedro Aspe in Mexico, Bibi Netanyahu, Margaret, Hilda, Roberts, Thatcher, Ronald Wilson Reagan, William Jefferson Clinton. There have been lots of structural reformers this decade, this past, since 78, when China started doing this. Manmohan Singh in India. Number two is the Arab Spring. Hosni Mubarak was sitting next to Anwar al-Sadat when Sadat was shot in 1981. He ran Egypt for 32 years. He was out in 6 weeks. He's in a cage now, as you know. Number three is the redefinition of Europe. Europe is attempting to redefine itself. These are the big stories of this century. And number four is the bridging of the Americas. Canada, US, Mexico, Central America, South America. These are the big stories of this century. And in each one of these, there's one country that's looking to the United States for help, for support, for solidarity. And in the case of the rise of China, it's Japan. In the case of the Arab Spring, it's the great state of Israel, which celebrated its 65th birthday. Does anybody in this room know what the word Israel means? Has anybody ever heard of Jacob? Jacob came out of his mother's womb holding his brother Esau's heel. Jacob means the supplanter in Hebrew. Jacob went on a trip after taking over and wrestled with an angel. He struggled with an angel and was injured. He took a new name, Israel. Do you know what Israel means in Hebrew? Israel means in Hebrew, struggled with God. Story number three is the redefinition of Europe. And there it's the United Kingdom, America's oldest friend and ally, along with Canada. And in the fourth one, it's the bridging of the Americas. And that one, ladies and gentlemen, get this, 74% of the European trade is within Europe. It does Germany no good to cut off the rest of Europe because they're going to cut off their own markets. 74% of European trade is intra-Europe. Asia, it's 54%. Guess what it is for the Americas? Canada, US, Mexico, Central America, South America. Guess what percent of our trade, even with NAFTA, ready? 24%. So we need to bridge, and in the case of the North-South, it's the United States, Mexico, Colombia, Chile, Peru connection. Because Mexico, United States, Colombia, Chile, Peru is different from Venezuela, Rafael Correa in Ecuador, Evo Morales in Bolivia, and now increasingly Dilma Rousseff in Brazil. Now, those are the big stories of this century: the rise of China, the Arab Spring, the redefinition of Europe, and the bridging of the Americas. Now we come to the big stories of this year, and this will help me quickly set where we're positioning. Then I'll turn it over to David. The first big story of this year is the Standard & Poor's performance and how it's done what it's done. Through last night, the S&P was up 24.2% this year. We see the S&P TSX index in Canadian dollars is up 7.4. The MSCI Canada, which takes into account dollars, is up 3.1%. It's a slightly different index. But the way it's happened this year, there's been no pullback this year. There was a May 21st, Bernanke says, is anybody in this room married? The big problems in marriages happen when one spouse says something and the other spouse heard something different. And everybody in this room knows which spouse it is that hears things wrong. But he said tapering and the market heard tightening. So we had a 1% decline for the month of June, and the only other month the market's been down is the month of August, and August 21st was the chemical weapons attack, and the market was down 3%. So big story number one is the S&P. It's been paced by healthcare, up 33%, consumer discretionary. The number one performing group, are you ready for this in the United States? Airlines, up 87% this year. That's part of the consumer discretionary. Story number two is the banks, the small caps, and the transportation index. Those three are canaries in the coal mine. You understand this expression? They are basically harbingers. Harbingers comes from the word herberge, meaning an inn, to stay in an inn. A harbinger is a place where you would go and rest. So these are advanced indicators, and they are up 28, 30, and 33%. The small caps, the banks, and the transports. Story three. Story one, Standard & Poor's and the Canadian index. Story two is the banks, the small caps, and the transports. Story three is Japan. Japan we still like. Last week we added 3% to the U.S. stocks, even though it's run up a lot, and it's late in the party. Don't get me wrong here. We're going in for one more drink and hope we can leave. Hope. Japan is up 37% with the yen down. It closed last night at 99.21. It started this year at 86.75. So the Japanese yen is down 13% this year. Story four, I can't believe this. The European banks and the inability of a problem in Italy and Cyprus to destabilize Europe the way the Greek elections did last year. And the most shocking number of all is the Irish 10-year bond at 354. A year and a half ago, it was 13. And the Greek bond is at 844. A year and a half ago, it was 33% yield. Story five is the horrendous underperformance of emerging market equities. Brazil is down 15% this year. Russia 3, India 11, China 2, and Korea, Taiwan, and Mexico flat, -3, and -10 now for Mexico. Story six is gold, silver, and gold mining shares. People talk about China and India demand. Forget it. Gold went up for the last 12 years because the dollar went down and interest rates went down. That seems to have stopped. Those were the big friends of gold. And copper, oil, the commodities indices are all down. And the last story is the 5 S's, the 5 S's. S number one is support by the Fed and the monetary agencies of the world. European Central Bank, Bank of Japan, Swiss National Bank, Bank of England. And you know who's going to have hearings tomorrow? Janet Yellen, day after tomorrow on the 14th, which is Prince Charles's birthday and my birthday. Number two, is the Syria. We've talked about that. It's on the back burner now. It's not off the table. Number 3 is the shutdown did not affect things, apparently. Number 4 is Larry Summers. And let me tell you, people always thought he would be horrendous. I like Larry Summers because my late wife liked Larry Summers. When our daughter was a freshman at Harvard, he was president. We got a letter, any of you parents in this room, that said if your daughter's got a drug problem or she needs an abortion, we'll take care of it. My wife went ballistic. She wrote Summers and said, until she's 21, she's mine. Don't you dare. And Summers had us into his office for 2 hours, and he agreed with her. And so she loved him, therefore I loved him. But Larry Summers, a good man, is not going to be roiling the markets. And last S is spying. And Scott McNealy, the president of Sun Microsystems, said, privacy, you have none. Get over it. And on that note, I will yield the floor to my distinguished colleague, Mr. Rosenberg.
David, thank you very much for all those enthralling insights. I actually don't think I know anyone else in the world that could wake up an audience quite like you can. And so thank you. Thank you very much. Now we have the distinct pleasure of asking David Rosenberg to share his economic update. David is the chief economist and strategist at Gluskin Sheff and Associates. He focuses on providing a top-down perspective on the firm's investment process and asset mix committee. David received the Bachelor of Arts and Master's of Art degree in economics from the University of Toronto. And prior to joining Gluskin Sheff in the spring of 2009, Mr. Rosenberg was chief North American economist at the Bank of America, Merrill Lynch in New York for 7 years, during which he was consistently ranked in the Institutional Investor All-Star Analyst ranking. Prior thereto, he was in 2012, Mr. Rosenberg was named one of the 5 most influential Canadians in investing by Financial Post magazine. He was the only economist recognized for his accurate economic projections in Fortune's magazine's Best and Worst of Wall Street in 2011, and was ranked most accurate forecaster for 2011 by MSNBC. In 2013, he was ranked one of the 12 smartest people on Wall Street by Business Insider. Can't be that bad. David, it's a pleasure having you.
Well, thanks, Mo. And boy, the internet's a wonderful thing. You can find out all these things about yourself if you dig hard enough. Anyway, I'm just going to say at the outset that before we got up here, I had the opportunity to bump into an old university professor of mine, Larry Smith. Here, raise your hand, Larry. And Larry actually taught me macroeconomics and taught me housing economics at U of T back in the early 80s. And we're talking, and he says to me, I was just talking with Ira Gluskin very recently. I said, oh, yeah? He said, yeah. He said, he mentioned a thing or two about you. I said, good or bad? He said, well, maybe a little bit of both. You know, he did say that, you could have done a better job being bullish on the equity market, but he said you did get the call in interest rates right. So what I'm going to do is just stick to my knitting and talk maybe about the one asset class that I feel most comfortably about. And I know that my reputation is that I was never quite bullish enough on equities, and that's because I was spending far too much time being bullish on the bond market until earlier this year. So I want to discuss my epiphany because I think that one of the things that I would consider to be one of the most major, if not the most major, financial market event for this year that I think is going to have tremendous implications for a variety of asset classes going forward is what's happened to the U.S. Treasury market, which as we sit today, the yield on the 10-year note is up almost 100 basis points. And that matters for every bond market around the world because inevitably everything from municipal bonds to corporate bonds to Canadian bonds to German bonds are priced off the Treasury yield curve. And what's interesting is that people feel that, how can you lose money in bonds? I can't lose money in bonds. But here's the reality, is that when the yields go up, the price of the bond goes down. So I think when people get their statements this year, they're going to find a big negative sign if they've been long plain vanilla bonds. In fact, the Treasury bond market so far this year has actually, believe it or not, delivered a negative 5% total return. Long duration bonds have delivered a negative 10% return year to date, which I think would surprise a lot of people. Now you look back historically and you're buying equities, and I agree with David that it is a little strange to go this long without a correction, but you're buying a risky asset. It's important to understand the risk, but equities are risky. So it's typically an asset class that takes 2 or 3 steps forward and 1 step back. Gold, of course, is down. Commodities are down this year. They tend to be more risky. Bonds are less risky, which is why in any given year when you have a minus sign for your total return in the government bond market, it's a big surprise. It's only happened 4 other times since 1981. And I want to talk about the reasons why this has happened, and I want to talk about why it is that I changed my view, because I'm one of these old-timers with Lacey Hunt and with Don Cox and with Gary Schilling, who for many, many years, spanning the different companies I worked for, I was one of these long-time bond bulls. And I put down my markers because, in this industry of forecasting, it's very important to stay disciplined. Very important to know at what point the straw breaks the camel's back and you're going to change your view, no matter how secular your view was, because the important thing in this business, as being an economic forecaster, is you never, ever fall in love with your forecast, because there's going to be a time when it ain't going to love you back. Fall in love with your partner, don't fall in love with your view. And this was a secular view in bonds, and it's an important development when you consider what Mr. Darst was talking about in terms of the Fed's relentless intervention into the fixed income market. Not just, by the way, the fact that the Fed has kept the cost to carry, has kept the federal funds rate at 0 for 5 years now, which means it's been negative for 5 years now. But of course, the Fed has coupled that with all these multiple quantitative easings, which means that the stable Federal Reserve balance sheet that historically rose with nominal GDP and until the crisis 5 years ago was around $700 billion in size, is now pressing against $4 trillion. And so the Fed used to come into the market to influence interest rates across the spectrum through the Fed funds rate. Today, the Fed is really in total experimental mode. Not just the Fed, but the Bank of England has done this. We're seeing the Bank of Japan do it. But ultimately, it is the Treasury market that drives interest rates around the globe. It's the only reason why 10-year Canada's are up 85 basis points this year as well. But it's very fascinating when you're taking a look that the Fed now controls, I shouldn't say controls, the Federal Reserve now owns 46% of all the outstanding Treasury notes and bonds beyond the 10-year maturity, 10 years plus. That's unprecedented. So despite all the Fed's greatest efforts to stimulate the economy, it's certainly done a great job stimulating assets, including the stock market. But what's really fascinating here is that the asset the Fed is buying, which is long duration bonds for the first time, all of a sudden this year, bond yields are moving in the opposite direction. So there's other factors at play. And I would suggest to you that if the Fed wasn't in playing the role of captive market for long-dated bonds, I imagine that 10-year Treasury yields today wouldn't be 2.8%. They might be closer to 3.8 or even 4.8%. But what we're learning firsthand is that despite the Fed's greatest efforts, and the stock market will do what the stock market's going to do, and we can talk about that, what we're learning firsthand is that the Fed does not control the entire yield curve. Yes, they control short-term interest rates, but they don't necessarily control long-term interest rates. They might be able to slow the pace of advance in bond yields, but they haven't stopped it. So, to invoke John Maynard Keynes, when the facts change, I change my mind. What do you do, sir? And I've always actually preferred this quote to we're all dead in the long run. I don't know about you, I always like this one a little bit more. And so what was the epiphany, or what was the change? Because I laid down my markers, because I got to tell you something, this was a big change in view for me. I was a long-term, I was viewed as a perma-bear, No, 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 no. I was a perma bull on bonds for a long period of time. And on a risk-adjusted basis, by the way, for 30 years, bonds provided the same returns that equities did, but with less risk. But the one marker was what happened last December. By the way, right around the time that Treasury yields were making their low. And I noticed more than just a nuance. This was a significant change in Federal Reserve policy. Now, I said before they've kept the funds rate at 0 for 5 years. We all know that. They've gone from QE1 to QE2 to Operation Twist to QE3. But you can see right up until December of last year, the Fed, in its guidance, would tell us that we're going to keep policy ultra-accommodative till mid-2013 or through late 2014. And then all of a sudden, December last year, Bernanke screams uncle and says, I'm no longer going to timestamp monetary policy. Basically, you do the math. I'm telling you right now, not until the unemployment rate gets to 6.5% and or inflation gets to a half point above our previous target, which was 2%, we're going to tolerate inflation up to 2.5%. And I said, whoa, Nelly. Okay, it's one thing to talk about 6.5% unemployment. Now they're backtracking from that because we're getting closer to that because the participation rate's coming down. And the big debate in the economics community is how much of that drop in the participation rate is cyclical, how much of it is structural, and nobody really knows the answer to that, including Janet Yellen, who, by the way, is an expert on the labor market. But let's just say that the other caveat, we're going to tolerate inflation expectations up to 2.5%. When you talk about in the 80s, whether it was John Crow here, whether it was Paul Volcker, the goal was to get to 2% core inflation. Then, by the way, before the crisis, during this great moderation that Ben Bernanke liked to brag about in the last cycle, the debate at the Fed and other central banks was, well, why stop at 2%? Price stability is great. Why not get down as low as 1%? And now they're talking about 2.5%, which, by the way, is not the end of the world. It's not the end of the world, 2.5%. But if bond yields were 4 or 5%, I would say, well, you have a cushion. And when we get to that level on yields, I'll say time to get back in. But who on earth would want to buy a 10-year note at 2.5, 2.6, 2.8, 3.0 when the Fed is telling you we actually want to get inflation expectations up to 2.5%? This is something new. And I got news for you. This is what I said to myself, was that 2.5%, my friends, is not price stability. The era of chasing price stability for 30 years has gone away. Now, I don't know how you get to 2.5% if the Fed's successful and you just stop there. Let's assume that they just stop there. The reality is that 2.5%, as low as that might sound, that ain't price stability. The price level doubles compounded every 30 years with 2.5% inflation. So we are in some new environment. And the Fed is giving you a big heads up here. Of course, they're trying to slow the increase in bond yields, but we find out this year, even as they buy half the market, they can't stop the thing from going up in yield. And this is very important, also how you want to be situated in terms of equity sectors and how you want to treat the bond market. So we've come full circle here, right? We had a 30-year bear market, then we had a 30-year bull market, and it's perfect right now. It's perfect. You take a look back in 1981, inflation's 15%, bond yields are 15%. Everybody is talking about inflation going to the moon, interest rates going to the moon, led by none other than Henry Kaufman, who was the director of research at Solomon Brothers at the time. And what people underestimated was the resolve of the Federal Reserve to break the back of inflation. And it didn't happen overnight. It took the Fed 5 years and 2 god-awful recessions to break the back of inflation expectations. We get to today's environment. What do we have? We bottomed at 1.5% bond yields, 1.5% inflation, perfect symmetry. But we don't have anymore the most radical anti-inflationary resolve by the world's most important central bank. No, we have the most acute reflationary effort by the central bank. And what only separates the current situation of low inflation to the inflation we're going to see are lags. Just as we didn't get to the holy grail of lower inflation by Paul Volcker overnight. It took a good 5 years, but that's what to expect from the future. So when you had Volcker with the big stogie in 1982 and interest rate anguish, that's when you wanted to buy interest rates. That's when I turned bullish on bonds. And today we've come full circle with the hero. Anguish to the hero. So I would say if you can short government bonds. And by the way, at Gluskin Sheff, we can do that. We are doing that for the benefit of our clients. Of course, the Fed had the chance to taper in September. They took a pass. And the only person, just to show that we're not in Kansas anymore, Kansas City Fed President Esther George voted against it, saying we are sowing the seeds for higher inflation expectations. Then I would say to Esther George, well, don't you know, that's what your friends at the Fed want to do. And inflation expectations are starting to rise. I had this conversation with Larry Smith ahead of time. When's the inflation going to come back? We were debating about the lags. Inflation expectations are the critical component of bond yield determination, and even the Cleveland Fed's own measure is going up. But guess what? This is exactly what the Fed wants. So Bob Farrell, who was a mentor of mine at Merrill Lynch, he was chief market strategist for 50 years. Bob Farrell's 10 market rules to remember. These are the 10 commandments for investing. Bob Farrell's rule number 1, ratios mean revert. They mean revert. The 10-year note normalized by inflation expectations. You tell me if you want to buy bonds in that environment. They're about 2 percentage points too low right now based on that measure. What about actual inflation? Forget inflation expectations. You know, during this Bernanke episode, 3 different times, in real terms, bond yields went negative. It's as if you're paying the government for your money. And that is not sustainable. As it stands right now, we're barely above zero. Once again, whether you're taking a look at inflation or inflation expectations, bond yields are 200 basis points too low. That means that when I start turning bullish again, we'll be closer to 5% than we're going to be at 3, and right now we're 2.8. And in fact, don't take my word for it. On March the 1st, Ben Bernanke himself, Ben Bernanke, the man who can control short-term interest rates, who is trying to manipulate long-term interest rates, wrote a piece on March the 1st with a very sexy title called Long-Term Interest Rates. And it's a very technical report. Anybody needs a cure for insomnia, great read before bedtime. But he strips out the 3 major components of what constitutes a long bond yield. Inflation expectations, the term premium, and the anticipated path of monetary policy. And his conclusions are basically that we're going to be in a 4 to 5% range. His own conclusions. The man, the architect of this policy is telling you in the next 3 years, bond yields are going up 200 basis points. Of course, I look at this chart and I realize that at Gluskin Sheff, we do our charts much better than they do at the Federal Reserve. But that is the conclusion. We can talk about what it means. How do you invest around an environment of a steepening yield curve, a moderately stagflationary environment, which is what the future holds. And this, by the way, is what the Fed wants. And in economics, your assumptions drive your conclusions, and my assumption is very simple. The Fed is going to get what it wants. And there's just lag separating the current low inflation environment to what I think will be inflation, moderately higher inflation, not 1970s. We're not going to go back, I hope, and listen to disco music and wear bell bottoms again. But we're going back into a moderately higher inflationary environment. Be prepared for it. So what I tell our portfolio managers in-house is not just about shorting government bonds, but within the equity market, it's about having real inflation hedges. You're talking about screening for companies and sectors that have high capital labor ratios, companies that have high fixed costs, relatively low variable costs, and companies that have relatively high demand price elasticities. And there's different ways. Banks actually screen quite well here because in a steeper yield curve in this environment, interest margins do quite well. The Canadian banks have been good places to be over the past few months, and I think they'll continue to be good places to be. In any event, that's my major theme, and thanks for indulging me. Take care.
Thank you, David. Thank you very much. Question is for anybody that didn't hear, what if QE, quantitative easing, does not actually work? You have
Okay, so when you say doesn't work, do you want to explain what you mean?
Let's say they don't rebound, expect rebound in the labor market mistakes, way too long. What's the truth about that?
Well, the first thing is that they have, if you go back and read Bernanke's November 2002 speech, on the famous helicopter speech, they have a range of other tools. The bottom line is that the labor market is healing. It's certainly not great, but I don't know. I mean, if we're going to take a look at the last non-farm payroll number, we're starting to average 200,000, which isn't a boom, but it's certainly not bad. I think we have to take a look at this. You know, everybody talks about the Fed pushing on a string. We just basically went through a 3-year period where the deficit GDP ratio in the US went from 10% to 4%. We've gone through the most acute 3-year period of fiscal retrenchment in the United States in modern history. In fact, in the last 2 times where fiscal policy was this tight in the United States, the US economy fell into recession. I actually find it a miracle for all the lamenting about, oh, look how bad growth is. The fact it's even positive is absolutely incredible. So I'll tell you this much. If we can get something through these budget negotiations right now, and maybe that's a heroic assumption, but if we could do something that will basically water down the sequestering, which is a tourniquet on the economy, when you consider that baseline GDP growth this year is 1.5%, you had 1.5% fiscal drag, it's not going to be much to get GDP growth close to 3% next year. So this isn't a case about the Fed necessarily pushing on a string or the Fed's not doing enough or they're failing. It's they're battling the most intense period of fiscal retrenchment the U.S. has seen in the post-World War II period. Full stop.
David?
QE is not working. I'm quoting Larry Summers at the IMF conference on Saturday. My lesson from this crisis is, my overarching lesson is, it's not over till it's over, and that is surely not right now. We may well need in the years ahead to think about how we manage an economy in which the zero nominal interest rate for 5 years, it was cut to zero 2 days after Bernie Madoff told his sons he's been running a Ponzi scheme in December 2008. It will be 60 months now in one more month, in which the zero nominal interest rate is a chronic and systemic inhibitor, not stimulator, of economic activity. There's no evidence of growth that is restoring equilibrium. One has to be concerned about a policy agenda that is doing less with monetary policy than it was doing before, doing less with fiscal policy that it's been done before, and taking steps whose basic purpose is to cause there to be less lending, borrowing, and inflated asset prices than there was before. What's needed, your children know what's needed. What's needed is structural reform. And structural reform will come from people saying, I can't stand this anymore. Jarvis Gann in 1978, Proposition 13 in California. And 2 years later, it was Reagan and Thatcher.
Thank you. I just want to once again express our deep debt of gratitude. Thank you for taking time out of your extremely busy schedules to join us. These gentlemen will be around for a little bit. If in the break you have time, I encourage you to approach them. And as you come off the stage, we just will have a small token of our appreciation for you. And really, thank you again for joining us in Toronto.
You're my Einstein.